Hello and welcome back to the ROI Club. Today we have a stock analysis, Blackstone Minerals. Now, I don't usually share publicly the stock analyses on those stocks that are not part of the publicly available eToro portfolio. I share the deep dives for those in the Maverick Life or the one-man income insurance company portfolio that's dedicated to income investing. But today we're going to do both. We're going to we're going to have a look at Blackstone Minerals and do a little bit of a deep dive here and see what I think the thing could be worth and why I'm buying it, which is a spoiler alert income play. If you enjoy the content, please do like and subscribe, not only to the YouTube channel, but also to the Substack. There's free options, so you can get a hell of a lot of value out of it for free and then upgrade if you really want the best stuff. Today's take will be on Blackstone. Stephen Farrington and I kind of laughed over the week. He put out a wonderful piece on it, more of a qualitative piece as to how the company works. So I won't talk a heap around that today. This has been sitting in my OneDrive for a while, and so I'm just going to talk more quantitative from a numerical aspect. Disclaimer, nothing that I say is advice. So for the love of God, do your own due diligence. This is just me putting my ideas out there to the world. So, as of time of recording, at least, the company on one page, here's what we're looking at. Wonderful balance sheet. Okay, the thing's got no debt. and it's trading at a dividend yield. I think that's a bit rich. It's just been cut. It's not going to be at 12% this year, I don't think, unless you see a significant price fall. But if you're looking at something with return on equity of 30% plus, and that's consistent. The thing has been able to grow its revenues over the last 3 years at 20%, albeit a few funky years to form as base effects, I know. And this thing just doesn't have many expenses. And so your operating margins are humongous. Most of the revenues are going to drop to the bottom line. And it is, of course, an inflation beneficiary, capital light business. It's got royalties over volume and prices, mainly natural gas, but also with oil. And you're only being asked to pay sort of 9 times the EBITDA, or you're looking at another way at basically a 12.5% free cash flow yield, according to these numbers, which is really not unreasonable at all for a high quality company that's able to generate, let's just call it 30% consistently return on the equity in the business. And we're going to see why that's important. So the key points, I guess, not to get too into the weeds, but you're looking around about a dividend yield at 9%. It's just been cut. Okay. Its gross margin 86, net margin 67, has grown a lot over the last 10 years. And return on equity, recent numbers are around the 43% mark. So it depends on which period that you use, of course. P of 10 is being valued like a small cap, deep value shit co, but it's anything but that. Okay. You're looking at 16.8 million gross acres where their interests are. And a lot of that is natural gas. So normally that's not going to get me too excited. However, given the line of sight for the next, call it 18 months in the US, where the natural gas is far too cheap there, you've got um, LNG terminals being built coming online, and you've got AI requiring lots more energy. These will really add to the demand aspects of natural gas in the US. There's a huge export case for it in the rest of the world. And so I think you'll start to see the natural gas prices rise at which US producers are able to sell their gas. These guys get a clip on that ticket. And they're not going to have like call option status on that because they use derivatives. So that their upside is somewhat capped. But when you think on the flip side, that also means that their downside is capped. And so for an income play, this is beautiful. You've got a high margin, capital light business. They will do just fine in an inflationary environment. They're able to hedge in some of their prices. And so you've got a very steady, very reliable stream of income ahead of you for, let's call it, the next 10 years or so. So they don't have a working interest in much of their production. They sit back, cut the checks, and then collect the checks. Nat gas, 73% of production. Okay, so very, very high. Decent amount of reserve life left. And that's basically all I wanted to point out. Here you've got, in terms of their balance sheet or their positioning. They've been able to pay down a lot of that leverage. They're at the lowest point of leverage in their history. Okay, the company's got no debt. And why is that important? Well, if you've got a company that has a reliable income stream, got no debt, they've got nothing else really to spend it on. Yes, they can acquire more acreage, but that's going to support the dividend. And if you're buying something for the dividend, you want to know that it's there for the long term, right? At least I do. Return on capital employed. This beautifully shows the value of a superior business model. You can have the best management team in the world, but if it's a tricky business model with low margins, it's just very, very difficult to make that work. If you've got a sustained and reliable ability to deploy capital at high rates of return, your expected return on investment over the long term, channeling our inner Charlie Munger here, will be equal approximately to the return on the capital or the return on the shareholders' equity. Okay, this company uses no debt, so the return on equity is what you want to look for. And you can rely on that. If we take the company at their word here from their corporate presentation, we look at both their yield and their balance sheet, they're ahead of all their other peers with plenty of liquidity here to potentially take advantage of an opportunity should it come up. Return on equity over a longer term is verified secondarily by ticker terminal here on the left, and then you look at the dividend per share on the right. Okay, that's basically it. It's able to generate very high returns on equity. It's not so much a compounder unless you yourself, as the shareholder, want to reinvest those dividends in an opportunity where you can reliably get, at the very least, double-digit returns on your equity. And I think that that is definitely in play here with Blackstone Minerals. The more advanced opportunity on top of that is to use the options market to really juice the yield. And if you're interested in doing that, and that's where if you upgrading to the premium version of this publication, I show you the exact trades that I use, buying dividend stocks and then selling various option strategies on top of that. So what do we need to work out what is a decent price to pay for the company? We need to know what it's going to earn. In this case, we're interested in dividends, and then roughly what the market would be willing to pay. Okay, to add a market multiple on top of that. We go back over the 10 years, historically speaking, at least, the market's been willing to pay roughly 11 times the dividend, 9% dividend yield. And then, of course, you've got a 10x on the enterprise value to EBITDA. So whatever EBITDA it can produce, the market's usually willing to pay 10 times that. Whatever dividend it produces, the market's willing to pay, on average here, the mean, 11 times that dividend. Given the reliability and of this particular business model, that certainly makes sense, and we can use both of these metrics with a decent degree of confidence. So very rough, quick and dirty back of the envelope. What's the EBITDA that it could produce over the next 12 months? If we use that same average market multiple, I think you'll see some multiple expansion because these types of companies, as I mentioned, have an asymmetric benefit in the event of inflation. But anyway, let's just be conservative. My calculations, I think it's reasonable to expect the company to do roughly $1.84 a share in EBITDA over the next 12 months. 10x multiple on that gives us, of course, $18.40. It's currently trading for $15.62. So it's not one of my massive multi-bagger opportunities, but it's not for that portfolio. It's for the portfolio where I want a reliable income stream where I can go away and mess around in wherever, Latin America, I'm off to New Zealand next month, whatever, and have some income coming in. So you got an 80% upside on the equity. So that seems pretty good over 12 months. You should collect somewhere around a 9% dividend yield. That seems quite reasonable. And of course, you could use it with the options market and by selling some out of the money covered calls, some out of the money puts to enter into the position at a lower price, so on and so forth. I'll show you what I'm doing that there inside the premium section. And with that all said and done, you should be able to get a yield above 10% with a maybe an 18% upside equity kicker on top, depending on the market conditions. If you're getting a multiple expansion, who knows? It may even be a lot better than that on the equity upside. A 10-year outlook, this company is fairly reliable, fairly knowable in terms of what you could expect there conservative estimates of their revenues and hence net income to be. So if I buy it today, just as a thought experiment at 15.62, the initial dividend is, I think you're going to get $1.55 over the next 12 months. The company's announced that. I think it's reasonable. Your dividend growth rate, 4.5% annually. It depends on which period you've used. So I used 2016 to 2024, so I cut it short a little bit. But if you went back from 2014 or 2015 to 2024 and you looked at the dividends and calculated a growth rate there, it'll be almost 20%. I didn't use that for conservatism, obviously, but also because after 2014 and 2015, the oil market went a bit funky. So I just left that and tried to smooth it out a little bit. If I get the same multiple today as the market's willing to pay, you add up, you discount those dividends, and you assume reinvestment with this, and you're looking at 197% on the upside, or about 11% annually before you juice it with any option strategy. Okay, so that seems reasonably reliable, and I think it can play a solid role in an income based portfolio. One word on that is the type of structure the company is. If you're a foreign investor and not in the US, you may get slugged fairly heavily with taxation. So your strategy, if you can work out a dividend reinvestment strategy that avoids that, or if you can hold it in one of the various retirement account options that you have access to in the US, then you should be able to compound this nicely without getting slugged the withholding tax. So that is one drawback to this particular type of company. Having said that, that's all for today. I hope you enjoyed that. Please do like, share, subscribe, and leave a comment. And I look forward to catching up with you in another video or newsletter shortly.